I think there's a ton of opportunities, that we have across Asia. There's something for everyone. If you are into core, we have developed markets like Australia, Japan, Singapore, even Hong Kong. And I would add in emerging markets in the region are also something to look out for. So if your allocation allows for that, then I would encourage you to look at them as well. So it's an exciting time to be in whilst we live in a world where there's a lot of macro uncertainty. There's also a lot of opportunities that the region offers. So I hope that you can take a look at Asia Pacific as a long-term investment opportunity.
Hello and welcome to the REIT Report. I'm your host, Sarah Borgson-Keto. Today's episode was recorded earlier this summer on location at REITweek 2026 in New York City. I was joined by Sigrid Zialcita, CEO of Asia Pacific Real Assets Association. Sigrid joined APREA in 2019 and is a recognized expert in global economic, public policy, and real estate issues. Sigrid, thanks for joining me today.
Oh, thank you so much, Sarah, for having me.
So, Sigrid, when we spoke last year, APREA was celebrating its 20th anniversary. Can you describe the role that REITs have played in advancing the growth of real assets in the sector?
Sure thing. So, looking back over the past 20 years, real estate across Asia Pacific was largely a local, opaque, and illiquid asset class, and primarily dominated by direct ownership and also some bank financing. So, over time, REITs have changed the landscape for real estate in general. They have democratized access to institutional quality real estate by opening access, to a broader investor base. And as a result, we've seen the standards, for governance, transparency, reporting being elevated as a result. And this has actually built confidence among global investors. Importantly, I think REITs have also introduced liquidity into a very illiquid market that used to be an illiquid market. And they have connected international capital to local markets. I would say also elevate the professional management of the assets and also play the central role in modernizing, I would say, the real assets in many countries across Asia.
And how do you think the definition of core real assets is changing in the Asia-Pacific region?
So the definition has actually been evolving over the last few years. So global investors previously have associated core real estate in or core assets with trophy or prime office buildings, and I would say flagship retail assets as well. But these days, that definition has actually taken on a different, or I would say level up, in the sense that there is greater emphasis on the resilience of income and also long-term demand drivers. And so now we would say other assets like logistics, multifamily, data centers, these are now being considered as well as part of core assets. The definition has certainly expanded from the premium quality office assets into the more durable, adaptable assets that include other alternatives, in the space.
Right, so it's really expanded that definition.
Expanded a lot, yeah, and just, looking at, again, the resilience of income and also the demand drivers for those assets.
And can you speak to the sort of variation that you see across Asia Pacific when it comes to market maturity, liquidity, and investor participation?
Many investors think that Asia Pacific is one contiguous market, but we're not. So there is I would say there are two groups. So you have the developed markets like Australia, Singapore, Japan. I would also include Hong Kong as being part of that. They have deep liquidity, strong institutional ownership, and I would also add in very strong, robust regulatory frameworks in those markets. So if you look at the market capitalization of REITs in Australia, Singapore, Japan particularly. So they have been growing over time. I think in the case of Japan, the dollar equivalent has actually shrank. It's just because of currency fluctuations and currency changes. But if you actually look at them, they account for a significant portion of market capitalization in Asia Pacific. In Singapore, REITs account for 10% of the total market cap in the Singapore exchange. Now, in contrast, you have the emerging markets. I would put in like India, China in the context of REITs being a
Right.
nascent asset class. And I would add in Philippines, Thailand, even Malaysia. And so Malaysia is still an emerging market. However, in terms of market cap, they're still quite small relative to the other markets I've mentioned. And the frameworks there are still evolving, particularly in India and China and the Philippines. So these are the three markets that we have seen over the last 2 years where a lot of legislations have been introduced and in a good way because these reforms are meant to increase the investor base and also ensure that REITs are a compelling asset class that investors should be looking at. So the thinking that in terms of reaching a certain level of maturity, that actually changes for every market. So for global investor, it cannot be a one size fits all approach for APAC, but of course can be a portfolio that actually includes both the developed and also the emerging markets that I have mentioned.
Sigrid, I wanted to ask you about the extent to which geopolitical tensions and supply chain realignment are reshaping investment strategies across Asia Pacific. And would you say that investors are changing where they deploy capital as a result?
Certainly. We are seeing actually manufacturers across the region diversify production across multiple countries. And one of the main reasons is this China plus one strategy. Previously, China was like the hub for manufacturing. I think 20 years ago, where it has always been known for its low cost production, but that has changed over time. Not to mention that with many of the macro developments disrupting some of these operations, we had COVID, for example, in 2020, 2021, and in some markets that have, spilled over to 2022. But what many manufacturers realize is that you cannot be dependent on just one market to have your operations. And that has certainly driven a lot of demand for logistics, industrial parks, and related infrastructures in, let's say, in South India, in India, particularly also in emerging Southeast Asia, including Vietnam, Indonesia, Philippines. I would add in also Thailand and Malaysia. So many of these markets have benefited from that. And we have seen a concurrent, obviously, increase in a lot of these facilities, particularly logistics. And what we have seen is that, especially over the last year to date, and with the Middle East conflict, we have seen investors really closely looking at some of these emerging growth corridors to set up their operations. There's definitely a heightened interest, but this is also being balanced by political stability, regulatory transparency, because these are investments, significant investments that have to be made. And so these markets are also having to ensure that they can offer them. And so far, I think if you look at the performance of the emerging markets I've mentioned in Southeast Asia and even in India, many of these markets have thriving real estate sectors, I think, pretty much including infrastructure.
Sigrid, putting together all the factors that you've spoken about so far, how would you characterize REIT performance in 2026?
Yeah. Let's talk about 2025 because that was the year in Asia we saw a recovery in performance, and it was actually the best year for REITs since 2019. However, the performance in 2026 has been a little bit soft. There has been a marked deceleration. Obviously, one of the factors has been the ongoing conflict in the Middle East that has dampened sentiment in many of the markets. And so, as we all know, that REITs are obviously exposed to that. Now, that being said, the deceleration in performance has been particularly pronounced in Australia, Japan, Singapore a little bit, but for Australia, they do have a lot of the REITs being concentrated in the traditional real estate sectors like office, retail, and these two sectors are still challenged to date. The work from home trend is still apparent in Australia, but has improved in terms of people coming back slowly to work. I think we've seen that in Sydney. And the REIT performance is certainly reflecting that, apart from the macro development I've mentioned to you. Japan, they are obviously affected by the change in the monetary policy. The BOJ, unlike the rest of the world, is increasing the interest rate, right? So the yield spread, which J-REITs have been known for. So last year, they offered, I think they're one of the highest, offer the highest yield spread in Asia Pacific. That's no longer the case. And so that is certainly a headwind for the J-REITs. And you can see that in the performance. Singapore, I think, is more affected by the sentiment. But if you look at the commercial real estate performance, it's actually quite strong. It's bucking the trend in terms of office, industrial, residential. And so I would say the performance still has some runway for hopefully for the balance of the year. But the story for the emerging markets like Thailand, which is the number one in terms of returns for the year, they have benefited from this supply chain realignment we are seeing in many places. And in fact, one of the companies, and this is not an endorsement at all, but it's just stating a fact that like Fraser's Property Thailand Industrial REIT reported a 10.6% surge in investment profit for this year. And so they're benefiting from the massive demand for logistics properties in Thailand. And so we're seeing that in Malaysia. Malaysia's economy has been quite resilient, and the commercial real estate in general has been doing well, particularly on the industrial side. It has a similar issue on the office for having a lot of supply, but with a lot of the technology companies looking into Malaysia as a hub for their logistics and data centers, it's certainly helping them. Hong Kong is another one that's also having a good year, but last year was a fantastic year for Hong Kong. However, in terms of the commercial real estate performance in Hong Kong is still challenged, until today. I think there are some demand drivers that are structural, we're seeing some structural changes. Retail is also being affected in the sense that there are a lot of locals and the mainland Chinese now obviously shopping elsewhere that has impacted Hong Kong. But we are seeing some, green shoots over there, and hopefully the REITs, we're hoping could regain some momentum for the balance of the year.
So it does sound fairly optimistic in
Um,
general.
I think, yeah, I mean, we are expecting for the balance of the year. Hopefully, the wild card here is if, I mean, we have the Middle East conflict that is really a drag on the performance because it's making a lot of investors pause. It's not just on the listed side, but obviously on capital deployment on the private side. It is something that is essentially slowing down or delaying decisions for many. Yeah. But if you look at the performance, however, Sarah, I would say that investors really need to look at Asia because our growth in Asia is still going to be the highest globally. It's about 4% growth rate. No one is going to be reporting a recession unless oil prices shoot up dramatically, right? And we are a very oil dependent region. However, I think measures are being taken to ensure that oil prices don't go up dramatically unless, something happens. But performance wise, I would say fundamentals in many places are actually quite intact. So we are expecting REITs to be performing, even in China where the economic slowdown is still quite evident. If you look at the REITs, the performance is actually doing okay. I mean, this year has been positive. It's close to 1%. And we are going to be seeing more commercial real estate companies or REITs that will be listed. So just put this into context, Sarah. So China REITs, when they were actually launched, it only included the REITable assets were primarily infrastructure. And the rationale for that is that the government wanted the REITs to be supportive of economic development in China. And over the last few years, couple of years, they have also expanded the asset class to hospitality, to retail. And in December, they've actually included your traditional assets like office being part of that. And it's huge because China has a lot of office assets. I think in Asia, it's like number two in size. And so we're seeing a lot of the REITs that are getting listed. These are the high quality real estate, by the way, that are being included in the REITs because there are some concerns from investors about the softness in China and that will some of the buildings that have high vacancy be part of the REIT. The government is pretty strict about that only buildings that are actually stabilized that could be part of the REIT, when they get listed.
In several markets, public real estate valuations and private market values have not always aligned. So, how do you see that gap evolving, and what do you think could ultimately close the disconnect?
I think in many markets that is something that, still being sorted out because it's not the same story for every country. But what we're seeing is that with greater clarity on the interest rates, improving operating performance, we're seeing actually the gap between public, so for REITs, and also for the private companies, for the private funds, we're seeing that narrow, but the gap obviously existed, was very pronounced when people were quite uncertain about the interest rate in the different markets. Because in China, the interest rate has been going down, for example. Japan has been going up. In the past, it was going down. And these are all like affecting a lot of the valuations, right? So I would say in many places where there's more clarity in terms of the movement of the interest rate, operating performance is obviously better. We're seeing the gap between the two narrow. I guess the question is that are REITs also trading at a discount? Certainly in many places they still are.
So, it's an ongoing issue.
It's still an ongoing issue. Yes. And I always say this in Asia that it is a fantastic time to be buying REITs, especially if you look at the performance. And as I explained a while ago, if you look at the underlying performance of the REITs, the assets are all doing very, very well. And if it's trading at a discount, I see it as a fantastic opening opportunity for investors to be looking at. And the dividends are also quite attractive in many of these places. Can be around 6-7% in Singapore, 6-7%. In China is about the same. And, so it varies per market. But in many places, I would say it's still trading at a discount. And it is a great opportunity for investors to capitalize on.
Great. Hopefully that they hear that message. And climate resilience is something that's very important in the region. In terms of asset valuations and capital flows, how is that impacting those factors?
So, climate resilience is a very important issue that a lot of our stakeholders in Asia is obviously looking at. It's shaping investment decisions, the strategies, approaches, and clearly the valuation is affected. Just to give you a sense, Asia, we have a number of coastal cities. We have a lot of highly densely populated urban centers that are vulnerable to climate change. So you hear stories about typhoons, flooding, I would say earthquakes. We are vulnerable to that. And so what's happening, Sarah, is that investors are looking at how do they perform against those physical risks. So many of these things are being incorporated even at the design. In fact, one of our global members in one of our conferences in Hong Kong, I was pleasantly surprised to hear that they are now including sustainability at the design stage. And this was not even something that was being discussed 2 years ago, 3 years ago. So things have changed in the sense that, they're seeing that if the asset is not prepared to mitigate a number of these risks, the cost can be quite prohibitive. Insurance premiums can be very high that can actually elevate your operating expenses and eat into your profit margins. And so what we're seeing is that they're working now with a lot of these insurance companies as well, like what kind of targets do they need to have that can lower their insurance premiums, right? That can lower their vulnerability, let's say, to handling typhoons, the impact of typhoons on their assets, the flooding. And I would say for the cost of financing, in many places, it's still quite elevated, right? And so now a lot of these global banks, even local banks, since they're seeing a number of global banks offer sustainable financing. So we're seeing a number of companies, REITs are taking advantage of this. So they are essentially hitting their sustainability targets at the same time. They're having lower insurance premiums as well as lower operating costs because of lower financing as well. So, from a financial standpoint, it's actually quite positive the impact of taking these steps of preparing the asset against climate risks. There is a cost, but the return can be high. And why I say that, if I look at the REITs across Asia, and just looking at Singapore, where I am based, the REITs, they manage about 70% of trophy assets and office assets in Singapore. And if you look at the occupancies, they have the highest occupancies, about over 95%. And that's pretty substantial. If I look at other markets in the US, for example, where the office sector is still very challenged, right? And rents, I've never seen rents go down. In Singapore, at least over the last few years, CapitaLand, for example, have been quite successful in having to see rent premiums, and occupiers would be like, of course, it's very expensive. But then the cost of that is you may be paying higher rents, but the office building that you're in is what you really want. It's actually aligned also with, the sustainability standards that they also have within their companies. And so from a valuation standpoint, at least in Asia, I could speak to this, that it's actually very positive. In Asia, we call it as a green premium. We're seeing that. And the likes of GRESP, for example, they have the ratings and some guidelines, the well ratings. They have the ability now to quantify many things like air quality, water quality, and the things that you thought were just very hard to quantify. A lot of them have systems in place that allow them to quantify whether a building has all of the good things that the tenants are looking for, right? And then again, just going back to how does that translate to the asset? There, at least many of the assets I'm seeing are achieving higher rents relative to their peers.
So it really does pay in the long term to make that investment.
Absolutely. Because in 5 years, I think we're going to be seeing, if anything, it's going to be even more well established because it's not only part of, obviously, and it's great to see companies doing this on their own, but many markets now, like Singapore, Australia, they do have regulations that make you have to report what you're doing, and you're not going to be escaping this responsibility at all. So as a listed company, you have to be prepared. But I'm proud to say that this S-REIT, Singapore REITs, for example, they have been the pioneers in this space. Many companies are still playing catch up, but they're not. And you know what? It's actually playing for them. It's benefiting them because if you have all of these things, they're now part of these indices that are so important if you are a listed company. If you're part of an index, you have access to more investors, right? And that's just how it is.
So, Sigrid, looking out over the next 3 to 5 years, where do you see global institutional capital becoming most constructive across the region?
So, we are expecting capital to be flowing to, I would say, sectors that benefit from strong structural tailwinds. So, logistics, I would say digital infrastructure. So, that would be your data centers and living sector. The reason being is that I would say, sectors are benefiting from e commerce, artificial intelligence. I think we cannot escape AI. And then, of course, the demographics, Sarah. So in Asia, we still have a very young population. And so we're seeing demand for student housing, multifamily, and that's becoming especially more relevant in places where I would say housing can be quite expensive. So, like certain places in China, we're seeing multifamily assets doing very well just for that reason. So, in terms of the assets, we do expect those sectors. We do expect logistics, data centers, living sector. But on the geographic side, because Asia again is so huge, at least the global investors that we are in touch with are still allocating their capital to the well established markets, including Australia, Japan, Singapore. We're seeing also heightened interest in Hong Kong, but there's also continued allocation now and a growing allocation to emerging markets. India is number one, I think, in many of the global investors we work with, and also emerging Southeast Asia, including Vietnam, Malaysia, and Indonesia.
And how much effort and time are you putting into educating potential investors about these emerging markets?
Right. It is actually a lot. It has to be continuous. Many of these emerging markets, so like in India, in China, Philippines, so REITs are actually quite nascent. And so what we're doing is that first we are educating them on real estate and infrastructure, and then also the benefits of investing in a REIT and how it enhances your portfolio. So in Asia, many of the retail investors associate wealth with the physical real estate. So it is quite common that, many are actually investing in housing, condominium units. That's pretty common in Singapore. It's also in China. But we are educating them in a way that, hey, you can actually invest in real estate. You don't need to invest millions of dollars right away, but in the REITs, you can actually have a slice of the pie and still get yields that are quite attractive. Again, 6, 7%. I think that's the average dividend that we have in Asia Pacific today. So quite attractive. So in terms of education, it is an ongoing basis, but we're working first with institutional investors because they're the ones that can move the market. And when retail investors see what the institutional investors are doing, then, they tend to follow
Be
that.
interested.
Yes, yes. And so what we'd like to do is ensure that there is enough liquidity for the REITs to be attractive, right? So, but that requires a lot of education. So, workshops, thought leadership, and it's a year-long campaign and it cannot stop at all.
So much work to do.
It's so much work, but we live in an era of social media, so everyone has access to everything. So one of the best things, about being part of the Global REIT Alliance, we're part of, so APREA is a founding member of that, is that we get to work with the best industry trade bodies who are also promoting the same thing. We learn from each other and we just find a way how to spread the word, in terms of getting investors to be familiar with REITs.
And Sigrid, looking further out, which markets would you say are best positioned for meaningful growth over, say, the next decade? And are there any regulatory changes that perhaps could accelerate that progress?
My members will get mad if I say one market. This is the other stuff. But I do see, honestly, a balanced opportunity set, across Asia Pacific. There's something for everyone in terms of opportunities. Emerging markets like India, parts of Southeast Asia, the growth outlook for those markets is still quite positive. They're going to be driving the economic growth in Asia Pacific. And that bodes well for real estate. So essentially, investors can leverage on the urbanization that will be expected, continued urbanization that we can see in those markets. And obviously, real estate will benefit from that. Developed markets also like Japan, Australia, Singapore, they also are going to be core allocations to many global investors, and that will continue to be the case going forward. Now, China, people are always asking, what about China? We do think China is going to be coming back, and it can be a significant long-term opportunity for many if you have, of course, if your allocation allows you for that. I think patience is important, when it comes to China. But we do think that the ongoing regulatory evolution that we're seeing in China, I can speak for the REITs. I've been collaborating with the regulators on the ground in China. And CSRC, we work also with the exchanges, Shanghai Exchange and Shenzhen Exchange. And we are very, very positive about what's happening because one of the best things that we've seen in China is that they are willing to amend their regulations that can be to ensure that they are actually conducive to the growth of, let's say, REITs. So I would say that while China is still soft, it does get a lot of negative press or negative publicity. I would still say that do not write this off. It is too big to ignore. And there's still a lot of potential for this country. It is home to among the largest real estate and infrastructure in the world. And there's still a lot of room for securitization there. I would encourage investors to still look at China.
And Sigrid, you've given us a very comprehensive overview of the Asia Pacific region. Any final thoughts or anything that we didn't get to?
I think there's a ton of opportunities, that we have across Asia. There's something for everyone. If you are into core, we have developed markets like Australia, Japan, Singapore, even Hong Kong. And I would add in emerging markets in the region are also something to look out for. So if your allocation allows for that, then I would encourage you to look at them as well. So it's an exciting time to be in whilst we live in a world where there's a lot of macro uncertainty. There's also a lot of opportunities that the region offers. So I hope that you can take a look at Asia Pacific as a long-term investment opportunity.
Excellent.
Thank
Sigrid,
you.
thank you so much. And to our listeners, if you enjoyed this episode, please subscribe on your favorite podcast platform.